When we talk about accounting modules, we're really talking about the different specialized sections inside a full accounting system. Think of an accounting package as a large, modern building with many rooms, and each room has its own specific purpose. One room might handle payroll, another might deal with accounts payable, and another might take care of accounts receivable. These modules are connected to each other, so information flows between them smoothly, just like doors connecting the rooms in a building. This means you don't have to keep entering the same information over and over again. Once it's entered in one module, it's available wherever it's needed. In this lecture, we're going to step inside the Receivables Ledger module, the part of the system that deals with money owed to the business by its customers. This is sometimes called Accounts Receivable. It is an essential part of any business that sells goods or services on credit. If you run a business and you allow customers to pay later, you need a reliable way to keep track of who owes you money, how much they owe, when they are supposed to pay, and whether they have actually paid. The Receivables Ledger does exactly that. How a computerized receivables ledger works. A modern computerized receivables ledger does much more than simply record the amounts customers owe. It constantly keeps the records up to date. Let's imagine a medium-sized business that sells electronics. Every time a customer buys a laptop on credit, the sales invoice is recorded in the receivables ledger. The system immediately increases that customer's outstanding balance by the amount of the invoice. But the power of the system doesn't stop there. It can automatically generate useful reports and outputs. For example, it can produce daily sales listings so that management knows exactly what was sold each day and on credit to whom. It can create monthly customer statements that summarize all transactions for each customer. These are often sent at the end of the month, so customers can check their accounts and arrange payment. It can also produce quarterly sales analysis reports showing patterns and trends, like which products sell the most, which customers buy the most, and which sales periods are the busiest. The system can even produce information periodically for special purposes. Suppose your marketing department wants to send out promotional offers only to customers who have bought in the last 6 months. The Receivables Ledger can provide an accurate list of names and addresses for exactly that group. Or imagine a customer phones in with a question about their account. With a computerized ledger, you can search their records instantly and respond right away. The processing of receivables. When we talk about processing in a receivables ledger system, we're talking about the work a business does to keep track of how much each customer owes. Imagine each customer has their own personal account in your system, and that account is like a living record. It changes whenever the customer buys something on credit or makes a payment. The primary goal here is to update this account so it always shows the correct amount outstanding, meaning the amount the customer still owes you. Now, how do we update it? That depends entirely on the type of transaction we're entering into the system. If it's a new invoice, the amount the customer owes will increase. If it's a credit note, maybe because the customer returned goods or was overcharged, the amount they owe will decrease. If it's a remittance, a payment from the customer, the amount owed will also decrease. So the receivables ledger is like a financial diary for each customer. Every sale, return, adjustment, or payment gets recorded there, and these entries either increase or decrease the running total, the brought forward balance. When we begin processing for a new accounting period, say the first day of a new month, we start with the amount the customer already owed at the end of the last period. This is called the brought forward balance, often written as BF. Think of it like starting a new page in your diary and writing at the top, "We begin with this much debt carried over from last time." For example, if last month ended with the customer owing $500, that $500 is the brought forward balance. The carried forward balance. Once all the transactions for the period have been entered, all the invoices, credit notes, adjustments, and payments, we reach the closing figure for that customer's account. This is called the carried forward balance. It's simply the ending amount they still owe, and it becomes next period's brought forward balance. So if you start with $500, add a $200 invoice, subtract a $100 credit note, and subtract a $300 payment, you end up with $300 at the end of the month. That $300 is the carried forward balance, and when the next month begins, it will become that month's brought forward balance. Every accounting period begins with a brought forward balance. This is the amount the customer owed from the previous period. For example, if at the end of January a customer owed $500, that $500 becomes the brought forward balance at the start of February. During the new period, transactions happen that either increase or decrease this balance. If the customer makes new purchases on credit, invoice values are added to the account. Sometimes there are positive adjustments, such as adding delivery charges or applying interest for late payments. These additions increase the amount the customer owes. On the other hand, there are also deductions. If the customer returns goods, a credit note is issued, reducing the amount owed. There might be negative adjustments, like correcting an overcharge. And of course, when the customer makes a payment, called a remittance, the amount owed decreases. When all these additions and deductions are accounted for, we reach the carried forward balance, which is the amount the customer owes at the end of the period. This carried forward balance becomes the brought forward balance for the next period. Methods of updating accounts. There are two main ways to update a receivables ledger. The balance forward method is quick and straightforward. It focuses only on the total balance owed without linking payments to specific invoices. For example, if a customer owes $800 and pays $300, the new balance is simply $500. The system doesn't specify which invoice was paid. The other method is the open item method. This one is more detailed and precise. It matches each payment to the specific invoice it relates to. If a customer owes $200 on one invoice and $300 on another, and they pay $200, the system marks the first invoice as paid in full and leaves the second one unpaid. This method is more work, but it gives a much clearer picture of which invoices are still outstanding, making it easier to follow up on late payments. In fact, most accounting experts recommend the open item method because it provides better control and accuracy. Outputs. From the receivables ledger. One of the strengths of a computerized system is the variety of outputs it can generate. It can produce a complete list of all transactions posted each day. This daily record is vital for audit purposes, allowing auditors to trace and verify every single entry. It can automatically produce invoices if the package is set up to do so, saving time and reducing human error. It can also create end-of-month statements for customers, making it easy for them to see what they owe. Another very important output is the aged receivables list, which breaks down debts into categories such as less than 30 days old, 31 to 60 days old, and over 90 days old. This helps the business identify which debts are overdue and need urgent follow-up. Sales analysis reports help managers understand which products or customers are most profitable. Customer reminder letters can be generated automatically to prompt late payers. The system can also produce customer lists for marketing or mailing campaigns, and it can respond to inquiries instantly, displaying the answer on screen rather than requiring a printed report. In integrated systems, the receivables module can even send information to other modules, such as the inventory control or general ledger modules, ensuring that all records in the business remain accurate and consistent. The big advantages. The advantages of a computerized receivable system go far beyond simply keeping records. It improves accuracy, because calculations are automated and errors are minimized. It improves speed because reports and outputs can be generated instantly. It supports cash flow management because overdue accounts are spotted quickly and follow-ups can happen without delay. And it improves customer service because customer questions can be answered immediately with accurate, up-to-date information. From a management perspective, this system is a powerful decision-making tool. By analyzing payment patterns, the business can identify customers who always pay on time and those who frequently delay. Promotions can be targeted more effectively, and risky customers can be managed more carefully. In short, the Receivables Ledger module is not just an accounting tool. It is a vital part of running a healthy, profitable business. A computerized trade payables ledger is a special part of an accounting system that keeps track of all the money a business owes to its suppliers. These suppliers are the people or companies who have sold goods or services to the business, often on credit, meaning the payment will be made later. Just like a mirror reflects an image, the trade payables ledger is often described as the mirror image of the trade receivables ledger. The receivables ledger deals with customers who owe money to the business, while the payables ledger deals with the opposite side, the business owing money to others. One focuses on sales, the other focuses on purchases. This is why both ledgers are similar in structure and function, but their direction of flow is reversed. The main job of a trade payables ledger is to keep this record accurate and up to date. It also needs to produce various useful reports whenever the user, often an accountant, finance manager, or auditor, requests them. These reports could be used for budgeting, payment scheduling, supplier negotiations, or simply to maintain transparency in financial operations. Inputs into a trade payables ledger system. To understand what goes into this ledger, imagine you are the business owner and you receive goods from a supplier. The supplier sends you an invoice, which is a document showing the items you bought, their quantities, prices, and the total amount you must pay. That invoice will be recorded in the trade payables ledger. Sometimes you might return goods to the supplier. Maybe they were damaged or incorrect. In such cases, the supplier will give you a credit note, which reduces the amount you owe. That credit note is also recorded in the ledger. Payments you make to suppliers, whether through bank transfers, checks, or other means, are also recorded. In addition, adjustments might be made for other reasons, such as correcting errors or applying discounts. So, in short, the ledger records all purchases made from suppliers, all returns and credit notes received, all payments made to suppliers, any necessary adjustments to the amounts owed. Processing in a trade payables ledger system. Once the data is entered, the ledger must process it. Processing means updating the outstanding amounts owed to suppliers. If you think of each supplier as having their own mini account within the ledger, then every purchase you make increases the amount you owe to that supplier, while every payment you make decreases it. In the receivables ledger, the balances are debits, money owed to you. In the payables ledger, the balances are credits, money you owe to others. Apart from this difference in balance type, the way we update the payables ledger is almost identical to the receivables ledger. For the most accurate and transparent accounting, the open item method is considered best. This method matches each payment directly against the exact invoice it is intended to pay. That way, you can easily see which invoices are fully paid, which are partially paid, and which are still outstanding. This is especially useful if you need to follow up with a supplier or resolve disputes over payment. Outputs from a trade payables ledger system. A good computerized payables ledger does more than just keep records. It can also produce valuable outputs. First, it can generate a list of all transactions posted every time the system is run. This acts like an audit trail, showing all the changes made and helping in case of any disputes or audits. Second, it can provide analyses of expenditure, breaking down how much you have spent on purchases for general ledger purposes. This is useful for management to see where the money is going and to control costs. Third, it can produce a list of supplier balances, along with a reconciliation report. This report shows the balance at the start of the month, all transactions during the month, and the balance at the end of the month. Such reports help ensure that your records match the supplier's records. Lastly, it can create copies of suppliers' accounts. These might only show the brought forward balance, the current transactions, and the carried forward balance. If full details of unsettled items are shown, the ledger is called an open-ended ledger, similar to the open item method used in receivables. In short, the trade payables ledger is an essential tool for managing the lifeblood of a business's purchasing activities. By keeping accurate, up-to-date records and producing useful reports, it ensures that the business can meet its obligations on time, maintain good relationships with suppliers, and avoid the risk of missed payments or disputes.